Years ago, I learned some investing advice that absolutely changed my life, and I promise it's going to do the same for you, okay? Years ago, people were telling me, Sam, you need to start investing, you need to start planning for retirement. And I was like, you know what, that sounds like a great idea. I probably should. But I had no idea what I was doing, right? So, like most people, I'm sure, you just Googled, what stocks should I invest in? And you're scrolling through and you stumble upon a Reddit page, r/stocks maybe, and then on there you see some random guy, you call him Randy, who's saying, oh, I just put all my money in Apple, it's going to be a great investment. And you think to yourself, Randy just put all of his money in Apple. That makes a lot of sense. Maybe I should be investing in Apple because Randy clearly knows what he's talking about. So I went and bought some Apple just based off this Reddit post. And then I also had friends growing up that got super involved in crypto. And they were telling me about all these different coins and like it's going to completely replace the US dollar. I was like, wow, replace the US dollar. That's huge, right? But on the other hand, I'm already listening to Randy, right? So do I really have room to be listening to you as well? And the answer was yes, right? Not knowing what I was doing, the answer was yes, I'll also, invest in some of these crypto coins too. Long story short, I ended up losing money in the end, right? As most people do when they just, make these purchases on a whim. I would take money out because these stocks or crypto coins weren't doing well. I'd be like, I don't want to just watch this money go down when I could just take it and at least spend it on something, right? Put it toward groceries, rent, whatever it is, And that's when I realized I really didn't know what I was doing investing, and I needed to start learning some of the fundamentals. So that's when I discovered this incredible investing advice, okay? And I'm going to share it with you here today so that hopefully, you don't end up in the same position that I did, right? Now, first things first, hopefully this is common sense, but I'm not so sure that it is in the investing world. Don't listen to Randy on Reddit, okay? Don't listen to people who are just making posts on Reddit. Promise you, it's not going to work out well, okay? And then second, don't listen to your friends about investing either. Friends, family, whoever, okay? And it's not because, you don't trust them. It's not because you don't like them, but their financial situation is fundamentally different from yours, right? So even if, Microsoft or Apple might be a good investment for them, it doesn't mean it's going to be a good one for you, okay? So let's get into it. We're going to talk mainly about the difference between speculators and investors, okay? And there are three main things that we're going to be talking about that should hopefully kind of pave the way about the differences between these two groups and then how you can really focus and become an investor rather than just a speculator, okay? So back then, I was a speculator. That's all I was. I was putting money into things. I didn't really know what I was doing, and I was just hoping that they would go up, right? And so that kind of falls into the first difference between investors and speculators, all right? The first difference is what each group is focused on, okay? You have speculators that are mainly focused on the stock price, right? They're the ones that, they're going to be telling you, oh, it's all about purchasing stocks low and selling them high, right? They're going to tell you, oh, I think Apple's stock price is going to go up in the next couple months or year, so you should buy it now. Whereas investors, they don't really care about the stock price, right? For them, if the stock price increases, decreases, it really doesn't matter because they're focused on the business, right? They're focused on Apple as a company, not Apple as a stock price. And that's a really big mindset to have, right? Just making that small shift from looking at the stock price to looking at the company can really change your investing outlook and, the types of decisions that you're going to make in the future, okay? The second biggest thing is the length of time that these two groups are typically concerned with. You have speculators who, like I said, they're focused not only on the stock price, right? But they're the ones that are going to be talking a lot about what the price is doing in the next week, in the next month, in the next couple months, maybe even up to a year, right? Whereas investors, they're not worried about the stock price, they're worried about the company, right? So they take Apple and they're like, based on where Apple is now, based on the history of Apple, right? The growth rate, all of those things, their revenue, where do I see Apple going in the next 5, 10, 15 years, right? They're not concerned about what the stock price is doing. They're not even concerned what the stock price is doing in those 10, 15 years. They're concerned what Apple is doing in those next 10 to 15 years, okay? A great way to think about this is if somebody were to ask you, what do you think the stock price of Apple is going to do in the next month? Somebody asks you that question, right? There's a really easy mindset that you can get into that will help you focus on the long term rather than the short term. And that mindset is answering, I don't know, and I don't care, right? I don't know. That's true, right? No one knows what the stock price is going to be. No one can predict the stock market. It's a wild place. We see it with Trump even, right? Any statement he makes can cause these huge, 10, 20% swings in a day just based on what Trump is saying about tariffs, trade policy, things like that. So no one can predict the stock price. So that's an honest answer. I don't know. I don't know, right? Now, the second part of that is I don't care. And that might seem a little counterintuitive when you're investing. But as an investor, again, you don't care what that stock price is going to be in the next couple weeks, next couple months. You care how the company is going to be performing in the next 5, 10, 15 years. Okay? So when somebody asks you about the stock price, it's a simple answer. I don't know and I don't care. Okay? That's a great piece of advice. The second is one that Warren Buffett lives by. Okay? He says, if you made your investments today, if you bought some stock in a company today, and then the stock market closed for 5 years and you weren't able to sell any of those shares, would you be comfortable holding that investment? And the answer should be yes, right? If you're not comfortable holding that investment for 5 years without seeing the stock price and without the option to sell them, then you're not an investor, you're a speculator, okay? You need to be able to have the mindset that says, I'm not focused on the short-term stock price of this thing, right? I'm not even concerned about what this company is doing until at least 5 years out. So if the market were to close and you had no insight into the stock price of that company, you should be confident in saying, yes, I'm perfectly okay keeping my money in that stock over those 5 years, even though I don't know anything about it over those 5 years, right? That's some crucial advice and a huge part of the mindset about Warren Buffett and why he's been so successful, right? We don't see him selling stocks after just a couple months or even just a couple years. He holds these stocks for the long term, right? And that's one of the biggest mindset changes it took, especially for me when I started out investing, right? It's not about what the stock price is doing now. It's not about what it does in a year, right? It's what the company does in 5, 10 years from now that I'm really concerned with, okay? And then the third thing about speculators versus investors is what they allow to make their decisions, how they're influenced in order to make their decisions with, their investments, which stocks they're purchasing, when they're selling, things like that, right? Speculators, if you go back to me in my example, right? I was selling because I was fearful that I was just going to keep losing money, right? And that's a common trend with speculators, is that they let emotions control their decision making. They see that, and this goes both ways. This goes when the stock is going up, it goes when the stock's going down. It really doesn't matter because they're still letting these emotions control their decisions. So, for example, let's say you bought Apple, right? And then the stock's going up, right? It's going up, 3, 4, 5% a day for the next, couple weeks, right? You might be saying, oh, this is so easy to make money, right? I'm going to just keep buying Apple right now. And that may not be the best decision, right? Apple might be too expensive at that point, which we'll talk about how to price out a stock in later videos, but Apple might be too expensive. That might not be a smart buy right there. And so, you're making a decision based on the excitement of the market going up. Similarly, if it's going down, which is exactly what I did, right, is the stock's going down and you see you're losing money every single day, right? And you're like, wow, I could be using this money for something else, right? This just isn't working out for me. And so you sell it, right? And you sell it at a loss just so that you can have some cash on hand, right? And you see this happening a lot when, the market starts to make a downturn, right? Especially around like Liberation Day, not too long ago. We saw tons and tons of people selling off. And a lot of that is fear-based, right? They think that the market's going to crash and they're going to lose a lot of money. So they start selling their stocks. Again, allowing that emotion to control their decision-making. Whereas investors, on the other hand, they're really focused on the fundamentals of the business, right? If the business has shown consistent growth, if their balance sheet is good, right? If their projected revenue and earnings per share growth is good, then that's a sign for them to buy the company. It's a sign that it's going to be a strong investment. And so they should be owning a portion of that company. On the other hand, if they feel that a company isn't doing well anymore and that they might be faced with some strong financial burdens, right? Like they take on a lot of debt, maybe their growth has been decreasing for several years, that could be a sign to them to sell, because that investment, owning a piece of that business, they're not participating in those gains anymore. But again, this is over the long term. This is over 5, 10, 15 years, not just because a company does bad one quarter, right? So those are the three main things about speculators versus investors. And hopefully, you can kind of see how being a speculator really is what gives investing the correlation to gambling, right? Because you really don't know what you're doing. You're just putting money in and hoping to win in the end. Whereas investing, there's a strategy, there's an approach to this that ensures, you can't guarantee profit and gains from it, but you can ensure that you're not just throwing your money away like I was. Okay. Now, the last thing I want to talk about here is, great. Three differences between speculators and investors. How do I actually start down this path of being an investor? Right. And there are three more things that I'm going to talk about here. And these are going to be quick. First is know the company. Okay. Now, this involves looking at the financials of the company. Have they been growing over the past couple of years, right? If you look at Benjamin Graham, he's Warren Buffett's professor, or was Warren Buffett's professor at Columbia University. He looks back at least 10 to 15 years to see how this company's been performing, right? Now, granted, that's kind of a long time to look back. You may not have to actually do that, but just look, is this company reporting strong numbers, reporting strong growth over the past couple of years, right? And then are they going to be reporting strong growth in the future? That's number one, is know the financials. Number two is know the CEO and the business model, right? The leader of these companies plays a huge role in the way these companies move forward, right? Take AMD, for example. AMD was a major competitor, still is, to NVIDIA. They changed over their CEO, and a woman named Lisa Su came in. And when Lisa Su came in, you can see a dramatic shift in the growth rate of this company, right? She was able to completely change the company and make them profitable and successful and a legitimate competitor to NVIDIA, right? The same thing is happening with Nike right now, right? Nike kind of lost focus of what was happening. Their previous CEO made some bad decisions, so they brought in a new one, right? And he's really getting down to the fundamentals of the business and changing, the core of the business to be more successful. So it's really these CEOs and the business model play a huge role in how profitable and successful the company is going to be in the future. So that's step two. Step three is a plan called dollar cost averaging. Okay. If you look at the graphic on the screen here, you can see basically no matter what the stock price is doing, you're buying, but you're not just buying randomly. Dollar cost averaging involves taking a fixed amount of money, we'll say $1,000, and investing it at regular time intervals throughout the year. So whether that's $1,000 every week, every 2 weeks, every month, every 2 months, right? Whatever it is for you, whatever works for your financial situation, you're following this plan and you're making regular buys at the same time interval, right? So now let's take a stock like Apple, for example. If you invest $1,000 every month, just to keep the numbers simple, right? And Apple is at $100, right? You can buy 10 shares of Apple, okay? Now let's say Apple goes up to $200, right? Well, now you can only buy 5 shares of Apple in that next month because it's at a higher price, right? Let's say it goes up to $500, right? In the next month, now you can only buy 2 shares. But you see what's happening is the first month you bought 10 shares and then 5 and then 2, right? So you average those out together, right? And you end up getting a lower average stock price per share because you bought more shares when it was low and less when it was high. So in the end, no matter what the stock may be doing, right, whether it's low or high, you're still getting a good price because of the number of shares you're buying at lower prices and fewer shares at higher prices, right? Now, this again was put forth by Benjamin Graham, Warren Buffett's professor, like I mentioned, and it's the only proven strategy in the stock market that allows people to see gains over, the next 5, 10, 15, 20 years, okay? Now, you're not going to be seeing crazy growth. It's not going to be like Bitcoin going up, thousands of percent, in just a couple of years. But you're going to see consistent growth. And in the end, when you really need that money, you're going to see that it's grown over time because you're averaging the cost of those shares that you're purchasing. So those are the 3 concrete steps that you can really start to take to go down the path of becoming an investor rather than just a speculator. Okay. If you were to get started right now, today, and open up a brokerage account, those are the 3 things I would focus on. 1, know the company's financials. Okay. Are they a strong company financially? 2, is the CEO and the business model sound, right? Do they know what they're doing, and do you have confidence in them? And then 3, set up a dollar cost averaging plan. Even if it's just $50, $50 a week, $20 a week, whatever it is, put that money into a stock and make consistent purchases throughout that time frame. Okay. And I promise you will start to see gains. They might not be the most exciting, but the important thing is you're not losing money. Okay. Thank you guys so much for listening. Let me know what you think down below about the best ways to get started for beginners. And if you had any bad starts to investing, make sure to comment those below. See you guys in the next video.